morning, everyone. Mike Paciotti, iCM's Chief Investment Officer, back again for this week's Markets in a Minute. So light week this week after a busy one last week with just a few meaningful economic releases, some bank earnings, and a bit of political news. So let's just get right into it. After a whole slew of economic data the prior week, last week really had just two meaningful prints, CPI and PPI. Month-over-month CPI coming in as expected at 0.3 and 2.7% for the year. Really no surprise there. And core advancing 0.2 and 2.6 respectively, both a tick cool versus expectations. Now, month over month, not surprisingly, core services, specifically shelter, driving 23 of those 30 basis points and 1.9% of the 2.7% on the year. So story continues to be housing-related inflation there. Now, on PPI, was basically in line month over month, 0.2, and came in at 3% year over year versus 2.7 expected, a tick hot there. As we drill down, final demand energy prices were a big driver on the month over month, contributing virtually all of the monthly change in prices, and also indicating that there may be some wholesale inflation up the pipeline for the consumer. So something worth watching there. Now on the earnings front, a few of the big banks reporting in kind of a mixed bag so far. Bank of New York Mellon reporting a positive 5% earnings surprise, 202 versus 191 expected, and Bank of America at 98 cents versus 96 expected, both beating estimates. By contrast, Wells Fargo and JP Morgan with small misses, and Citigroup, the big loser so far, at $1.19 versus $1.65 expected, mainly due to a large one-time charge due to the closure of that Russian banking unit a few years ago. Now, one political item that I think is worth mentioning, as we approach midterms, it at least appears to us that President Trump is making it a priority to address home affordability. So just this week, there was an announcement about the potential prohibition of institutional ownership of residential real estate, as well as an intention to buy $200 billion worth of mortgage-backed securities with the idea of pushing rates down. So as expected, rates did fall by about 20 basis points to just below 6% on the national average 30-year mortgage before rebounding later in the week just slightly. Now, a few implications that we could see with artificial influence on rates, the pressure relief valve becomes currency, with the implication being both lower rates and yields and a weaker dollar, a plus for non-U.S. investments and real assets. So that's going to be it this time. Kind of a compressed week this week with the Martin Luther King Day holiday. We have final revision to third quarter GDP and the tail end of bank earnings to come. So have a good week, everyone, and we'll see you next Monday.